Something just happened that barely made a ripple in the headlines, but it quietly changed the timeline for global finance. The UK locked digital assets into commercial law. Barclays signaled that 2026 is when real implementation begins. Most people missed it, but institutions didn't. And if you connect those two signals, a very different picture of Ripple, RLUSD, and XRP starts to emerge. In the span of a few weeks, two things happened that most people treated as just more crypto noise. The UK quietly passed a law that formally recognizes digital assets as a distinct form of property. And Barclays Private Bank told its wealth clients that 2026 is the year global crypto regulation shifts from theory to active implementation. On the surface, neither of those sounds like a chart-moving event. There was no viral clip, no explosive headline, no 10x prediction attached to it. Price barely reacted. Most retail investors scrolled past and went back to arguing about ETFs and short-term moves. But if you step back and look at what institutions actually need before they commit serious balance sheets to tokenized money and assets, those two events are not just interesting. They are structural. One locks in the legal status of digital assets inside the UK's commercial law system. The other timestamps when major banks expect the infrastructure, the rules, and the risk models to be ready for real deployment. The tension in this episode is simple. Retail is still watching candles. Institutions are finally getting the environment they've been waiting for. One side thinks nothing is happening. The other side is quietly preparing to turn the rails on. Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. So let's start with the piece that sounds the driest on paper, but might be the most important. What it actually means when a G7 legal system says, in writing, digital assets are property. When most people hear, the UK now recognizes digital assets as property, they imagine a symbolic gesture. Maybe some tax language, maybe better treatment in court. Nothing that would change how large institutions behave. That is not what is happening here. What the UK has done is carve out digital assets as a third category of property in its commercial law framework. Traditionally, you had things in possession like physical goods and things in action like contractual rights. Digital assets do not fit neatly in either bucket. They exist as entries in distributed ledgers and databases, but they carry economic rights and can be transferred, pledged, or seized. By explicitly recognizing digital assets as property, the UK is doing three crucial things. First, it gives courts a clear basis for handling disputes, security interests, insolvency, and enforcement when digital assets are involved. Second, it gives lawyers and institutions a stable surface to draft contracts, collateral agreements, and custody terms that refer to those assets in a predictable way. Third, it signals to regulators that these assets are not ghost instruments. They sit inside the same legal universe as any other property used in commerce and finance. For tokenization, that matters more than any marketing language about real-world assets. You cannot have large on-chain positions in treasuries, loans, or deposits without the legal system agreeing on what the token actually represents and how it behaves in bankruptcy, in fraud, in disputes between creditors, or in cross-border enforcement. The UK's move closes a gap that practitioners have been talking about since the early Law Commission reports on digital assets. It takes years of academic work and consultation and freezes it into code that judges and lawyers must now treat as binding. That is the foundation on which serious tokenization markets can be built in London, not just experiments at the edge. And you can see why institutional players needed this. If you are a bank, a custodian, or a treasury platform operating in the UK, you can now write policies and risk models that treat on-chain positions as property in a defined way, not as a legal gray area that might get reinterpreted later. That alone moves digital assets from interesting to operationally usable. This is where the gap between retail narrative and institutional reality really shows up. Retail cares about whether an asset is regulated, in the sense of being allowed on exchanges or mentioned in a press release. Institutions care about whether the asset fits cleanly into commercial law. Commercial law is the invisible layer that decides what happens when things go wrong. If a counterparty defaults, if a custodian fails, if a client claims misappropriation, the judge is not reading Twitter threads. They are looking at statutes, case law, and the categories of property those assets fell under. That is where the real risk models live. When a jurisdiction like the UK takes the time to define digital assets as property, it is not doing it for retail sentiment. It is doing it so that banks, insurers, auditors, and corporate counsel can stop treating this space as a legal orphan. It allows them to say, if we tokenize a deposit claim, or hold Ripple's regulated digital dollar on a balance sheet, or use XRP as collateral, we know how courts will treat that position in the worst-case scenario. Once that certainty exists, other pieces can finally lock in. Custody contracts can specify the client's property interests in a way regulators accept. Prime brokers can offer margin and rehypothecation terms around digital collateral without wondering whether a judge will later say, this isn't really property. Treasury platforms can embed tokenized instruments in workflows, knowing that if a client's subsidiary goes into insolvency, the treatment of those positions is predictable. That is why the UK's law is more significant than its headlines. It moves digital assets fully into the world where real treasury and settlement decisions are made. It does not guarantee adoption, but it removes one of the last excuses for not taking tokenization seriously, and that is where the Barclays timeline comes in. Barclays' private bank outlook frames 2026 as the year when global crypto regulation moves from theoretical frameworks to active implementation. That language is worth sitting with, because it reveals how banks sequence change. From the outside, it has looked like a decade of chaos. Exchange collapses, lawsuits, approvals, reversals, new rules, sandboxes, and pilot programs. From the inside, many large institutions have been following a very standard three-step pattern. First, regulators define the perimeter. What is allowed, what is banned, what categories assets fall into. Second, institutions build or acquire infrastructure that can operate within those rules. Third, they actually turn those systems on and start to move material flows. Barclays is effectively saying that steps 1 and 2 are now far enough along that step 3 can begin in earnest around 2026. Stablecoin frameworks in the US, digital asset property law in the UK, MiCA in Europe, and licensing regimes in hubs like Singapore and Abu Dhabi have created a regulatory mesh. Custody, prime brokerage, and treasury platforms have been acquired or built to sit inside that mesh. If you are a private bank client reading that report, you're being told two things. One, the opportunities in tokenized assets and digital settlement are likely to grow meaningfully after 2026 as these systems switch on. Two, if you wait until you see the headlines about that growth, you are already late in allocation terms. Implementation is a process, not a single launch date. Banks do not wake up one morning and decide, today we use blockchain. They phase corridors, clients, and products in over years. This is why the combination of the UK property move and the Barclays timeline is so powerful. One locks in the legal language institutions needed. The other gives us a rare look at the internal timing expectations around when those institutions plan to actually use it. Zoom out even further, and you see that this is not just a UK and Barclays story, It is part of a global synchronization pattern. In the US, a federal stablecoin framework like the Genius Act gives dollar reference tokens a clear regulatory lane. Supervisors have signaled how banks can hold and use tokenized treasuries. Major enforcement battles over whether certain large assets are securities have largely run their course, including the long fight involving Ripple. In Europe, MiCA is phasing in a comprehensive regime for asset reference tokens, e-money tokens, and service providers. It is not perfect, but it gives both issuers and intermediaries a map. In the Middle East, jurisdictions like Abu Dhabi's ADGM have gone as far as naming specific fiat reference tokens as accepted instruments for regulated financial activity, including Ripple's digital dollar as a formally recognized settlement asset. Each of these developments on its own looks localized. A new rule here, a license there, a pilot program in another region. But taken together, they form a multi-jurisdictional environment where a company like Ripple can actually run a unified institutional stack without fighting existential battles in every market. Payments can be offered in one regulatory wrapper, custody in another, prime brokerage in a third, all under a coherent legal picture. Synchronization does not mean uniformity. The US, the UK, Europe, and the Middle East will not converge on a single digital asset code. What they are converging on is acceptance that tokenized money and assets are now part of the formal financial system, not an external curiosity. That is the environment in which Ripple's acquisitions and infrastructure choices make sense. If you line up Ripple's last few years of moves against this regulatory and legal timeline, a pattern emerges. Medico brought institutional custody expertise. Standard Custody added a regulated trust company capable of holding the reserves and on-ledger positions behind Ripple's regulated digital dollar. Ripple Prime, through the Hidden Road acquisition, created a prime brokerage layer that can execute and route digital asset orders for institutional clients. G-Treasury plugged Ripple's stack into the daily workflows of thousands of corporates and financial institutions already running complex multi-currency liquidity operations. Palisade added a programmable wallet fabric that can sit between custody, payments, and treasury systems, enforcing policy and security in a way regulators can understand. Rail extended Ripple's reach into merchant payments and embedded finance flows, giving Ripple's stable dollar unit and other instruments direct paths into card and payout networks. None of these acquisitions made much sense if your frame was number goes up. They make perfect sense if your frame is what stack will institutions need once digital assets are fully inside commercial law and standardized regulation. You need custody that supervisors trust, a prime broker that can access liquidity across venues, a treasury platform that can embed tokenized instruments in day-to-day operations, and a wallet layer that can enforce compliance and security rules at scale. That is the stack Ripple now has. And it is not designed for an anonymous DeFi future. It is designed for a world where digital assets are property, where stablecoins are regulated financial instruments, and where corporates and banks are trying to shrink settlement times without breaking their risk frameworks. That is exactly the world the UK's law and Barclays' outlook describe. Where does XRP fit into all of this, once the legal and institutional environment is ready? Not as a mascot, and not as a speculative side bet for retail traders. XRP's role is mechanical. It is a routing asset in a world where multiple forms of digital money and tokenized assets need to move quickly and predictably between ledgers, jurisdictions, and market venues. When Ripple's digital dollar is used as a settlement dollar in corporate flows, it solves the problem of having a bank-grade unit of account on-chain. But cross-border FX, cross-rail transfers, and movements between tokenized treasuries, deposits, and other stablecoins still require a bridge. You can use bilateral pools everywhere, but that is capital-intensive and brittle. A liquid neutral asset with deterministic settlement properties is better suited to function as a hub in that network. The XRP ledger is already designed for this kind of routing. Its built-in decentralized exchange, auto-bridging, and pathfinding logic allow value to move between multiple asset types through the most efficient route available. As AMMv2, tokenized deposits, and RWA compliance layers mature, XRP sits in a position where, if institutions choose to use it, it can carry the in-between leg of many complex flows without needing trust in a central counterparty. In the implementation era, the question is not, will everyone use XRP for everything? The question is, in a world where digital assets are property, stablecoins are regulated, and tokenized instruments are normal, which assets sit in the middle of the routing graph? XRP is one candidate that already has the ledger mechanics and the institutional stack around it. How much it gets used will be a function of corridor design, risk models, and incentives, not narratives on social media. Pulling these threads together, you can sketch a rough but useful timeline. 2024 and 2025 have been the years of alignment. Legal categories, like the UK's Digital Asset Property Framework. Regulatory regimes like MiCA and formal stablecoin laws. Licensing arcs, where companies like Ripple accumulate payment, custody, and brokerage permissions across multiple jurisdictions. Barclays is pointing to 2026 as the year when this alignment turns into active implementation. Not because flipping a switch suddenly changes everything, but because enough of the infrastructure and legal certainty is in place for banks and corporates to start moving real size. Think of this as the first phase of operational deployment. Select corridors, specific clients, limited product sets that prove out the rails under tight control. From there, 2027 through 2030 becomes the expansion phase. Tokenized treasuries move from pilots to standard offerings. Regulated stablecoins like Ripple's regulated digital dollar appear in more treasury dashboards as a normal settlement option. Wallet fabrics and custody stacks like Palisade and Standard Custody quietly hold larger and more diverse portfolios. XRP and other routing assets find their place in the plumbing, where they make economic sense. None of this guarantees a straight line up for any single asset. What it does suggest is that the nothing is happening feeling many retail observers have right now is mostly a reflection of where they are looking. The visible part of the market is noisy and often flat. The invisible part, the law, the licenses, the stack building, and the internal bank timelines, is lining up almost exactly the way an institutional adoption curve would predict. So where does this leave you if you care about Ripple, about XRP, and about the broader shift to tokenized finance? It leaves you in a moment that does not feel dramatic, but is structurally important. A major legal system has pulled digital assets fully into its property framework. A major bank has told its clients that 2026 is the first real implementation year. And a company like Ripple has already assembled the custody, prime, treasury, and wallet infrastructure built for that window. The central tension we started with is still there. On one side, charts that refuse to cooperate with simple narratives. On the other, an environment where the excuses for not using digital settlement rails are slowly disappearing. The question is not whether this switch gets flipped. The question is which institutions, which assets, and which rails will quietly become the default under the hood of global finance over the next 5 years. As a viewer, the most useful thing you can do is adjust your lens. Instead of asking, why isn't price reacting to this? Ask, what does this change in the legal and operational reality for institutions who might use these systems? Watch where property law evolves. Watch which stablecoins regulators formally bless. Watch which custody and treasury platforms large enterprises actually onboard. And watch whether XRP shows up in the routing paths of real corridors, not just in speculation. This channel will keep tracking those institutional signals, not as hype, but as infrastructure. Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.